Hello and welcome. Independence Day is coming up. That's also a good time to think of financial freedom and your own independence. Can you achieve that independence in your financial freedom, in the way you manage your finances, in the way you can actually project to see if your life can be as safe and secure as perhaps it is today? And if it's not, surely this is a good time to think and get on to it. To discuss this, I'm joined by Suraj Kaeley, Group President, Sales and Marketing at UTI. Thank you very much for joining us, Suraj.
My pleasure.
So let's start with the basic question, right? So we're talking about independence and freedom at a very large level. But what does financial freedom mean to an individual? What does it mean to you, or what should it mean to me?
Well, whenever I have discussed the subject of financial freedom, for most of the times the answer I have got is that, there is one large number that's in somebody's head, maybe 5 crores, 10 crores, 20 crores. And if I had so much money with me, I would retire, I would do whatever I want. But I feel that's a little bit far-fetched. On a realistic basis, the simple way to look at financial freedom is how many months can you survive if you had no other income? So on one extreme, you have somebody who won't survive even a day because they may have large mortgages to pay or many other reasons, why they are struggling. And on the other hand, there could be an individual who doesn't really need to work and has got enough in the bank. So I have found this as a very unique way of really measuring financial freedom. And I think the goal, of course, of every individual is to reach a stage where, they can survive comfortably if they didn't have any other incomes.
How many months is that figure?
Well, ideally, it depends on at what lifestyle you are. So if you're very young, then maybe 6 months to 12 months is a good number. Because if you're shifting a job, you need something else, or there's an event which happens. So normally 6 to 12 months is a good number. But I think over time, of course, you need to ensure that you're able to survive and retire very well. So I think that stage you have to reach at some point in your career.
Right. So when should I start thinking about financial freedom? The moment I start working, a few years later, when should I start applying my
Well, the honest answer is
efforts?
The earlier the better, right? Because for the simple reason that if you start early in life, you'll be able to save small amounts, compound it for a very long period of time and transform those savings into wealth. But if you delay it, then you really don't have much of time left. So it's almost like a limited overs cricket match. If your run rate is good from the first over, the last, it's a breeze to win the game. But if you really keep it till the last, many a times you end up losing. So, that same thing can happen to
you can hit the sixes,
unless you can hit the sixes, of course. Which is not easy in our business,
Right. So, now the question is, how does that translate into a strategy that is more focused towards mutual funds, or mutual funds as vehicles to achieve that?
Well, I think investors have a lot of choices, and traditionally they would end up saving in...
Okay, let me ask you this question before that then. So, why mutual funds?
Well, mutual funds, in a very simple way, are a conduit to really invest in some real investments. So, the way I have generally described mutual funds is that most of us have 3 kinds of requirements. One is we want to multiply our wealth, so we call it capital appreciation. Capital appreciation is best achieved by investing in equities because you're owning the business, and that ownership gains is what you're getting eventually. So mutual funds make it very convenient for you to hold a diversified portfolio of companies, right? And it's very convenient, and you can start with as little as 500 rupees, 1000 rupees, so it's very convenient. It makes it's affordable for every single person. And if you have large amounts, you can still participate in the same companies with larger amounts of money. So that's one extreme. Second is you want capital preservation, right? So which you typically do by keeping your money in a savings bank account. So mutual funds offer products like liquid funds, where the money is invested for very short term, almost zero volatility. I can't recollect more than 3 days in the last 10 years when actually we dip in NAV as far as the liquid funds are concerned. And then in the middle is for regular income, so what we call debt as a portfolio. So it's equivalent to a bank fixed deposit, right? So you want to invest in a bank FD. Instead of that, you can buy income funds. Of course, income funds will be a bit volatile because of interest rate movements.
But like we've had an interest rate hike today.
Absolutely. So
would I have to be concerned, or should I have been concerned because?
Well, it depends on what kind of an investor you are. So if you are a corporate investor, and you are investing your corporate treasury money in, and you have a view on interest rates, yes, you should be interested. But most of the retail investors who are long term in nature, I think it's just a news event.
And those are the people we are talking to today.
Absolutely. So they can just ignore. There's really no impact meaningfully that they should be wondering about.
Whether it's this interest rate hike or another one later, or the reverse the day after that.
So obviously interest rates are an important component of an investment decision. But from an investment standpoint, once you hire the mutual fund manager, right, let him worry about it. You continue doing your job, and whatever your investment goals are, if you have chosen the right set of funds, I think you'll be pretty okay. So let that worry be with the fund managers.
Right. So to recap, focus on financial freedom as early as possible. Mutual funds are the best way to achieve that financial freedom, and within mutual funds, you're saying look at a balance of liquid and equity as the
Absolutely,
need might
yes.
be. So now, how do you refine that further? How do I get down to the next step?
So I would say, let's assume if you're starting your career, right? So now when you're starting your career, your revenues or your income may not be very large. And the good part is that every year you're going to see an increase, hopefully, in your income, right? You'll have some increments and your money will continue to grow. I would say a younger person can actually put 100% into the equity markets, unless and until, of course, they have some responsibilities and they need to maintain some liquidity. But if you're staying with your parents and you have somebody to fall back on, you can do a larger investment on the equity side. But as you grow older, then it depends on how much expertise you build in investing. So let's assume a person who is 60, no expertise in investing. I would recommend that they could be 100% in fixed income kind of investments, because they cannot digest the volatility of the market. So depending on who you are, you can really choose. And typically a good investment is when it is well spread out amongst various asset classes, depending on your needs. So typically we give, 3 broad, spectrums there.
So Suraj, you've been in the markets for a long time and observed them as well. So if I look at 20 years as a horizon, and I look at gold, I look at equities, I look at real estate, what really has delivered for people, perceptionally and otherwise?
So interestingly, the last 20 years, I would say real estate and gold also have done okay, though equities have been the best bet. So it is not that gold or real estate hasn't done well, as in the last few years, of course, gold and real estate is struggling. But fundamentally, the reason equity tends to outperform all other asset classes is that here you're running a business. The job of the business is to produce profits. So somebody is actively trying to really build, returns, and that's why equities tend to outperform. In a gold, it's a buyer and seller. Whoever determines the price, that will what will determine. In real estate, there's a part of both, in the sense that you can give your house on a rent, so get a rental income. So that's equivalent of a dividend what you get in an equity. But by and large, the supply or the price of real estate will depend again on demand and supply.
Right.
So,
no, but I like that analogy. You're saying that buy into mutual funds because they invest in businesses where there are people, hardworking people who are toiling day and night to ensure that you get good returns.
Absolutely.
Right? In gold, there's no one working for you to ensure that the price goes up.
You hit the nail on the head. Absolutely.
And not really in real estate as well.
Absolutely.
Right. Okay. So if we now look forward, what's the time frame? I mean, how do I, because if I'm young today, I'm also looking for quick returns, because I'm planning for a nice holiday or a honeymoon or buying a small house in the near term or even a car.
Well, I have a very different perspective on it. So most of us in the industry will tell you 3 to 5 years should be your time frame for investing in equities. But in my view, you get nowhere in life by investing for just 3 to 5 years. The reason you're investing into mutual funds is that you want to convert your savings into wealth. And that can only happen if you compound. So let's just take a simple example. If you're investing ₹1 lakh and you leave it for 5 years, and let's assume the market doubles in 5 years, your 1 lakh has become 2 lakhs. But if you left it for 20 years and the same 5-year doubling got repeated, that 2 into 4 into 8 into 16, that 1 lakh converts to 16. So obviously, one of the key learnings for me has been that the time frame ideally should be about 20 years, because that's where you get the feeling of wealth. Your 1 lakh getting converted to 15, 18, 20, and those numbers are pretty large, So my view is that when you're looking at equity investing, 15 to 20 years is the least you should look at. If you can do longer, you will be surprised how much wealth you can generate by the sheer effect of compounding. Forget what the market delivers.
And what would be a good retrospective example? So let's say if I had put money, this is 2018, if I had put money in, let's say, 1988 or 2008, what would it be? So
let's take the Sensex. Sensex was 1979-80 base at 100. Today it is at about 36,000. So you can imagine you have multiplied your money 360 times over the last, let's say, about 38 years. So the longer you can just keep it aside, it makes a big difference. So even if you did in 2001, for example, you would realize your money has grown almost 10 times from those levels as well.
But would a mutual fund have grown the same way the markets did?
So mutual funds, of course, come through a lot of variety. So if you bought an index fund, yes, you would have replicated that. Fortunately for us, the mutual fund industry has actually delivered better than the market returns. So we call in our parlance alpha, that how much we beat the markets. And I think the industry as a whole has done a phenomenal job in the last 15-20 years to produce a reasonable alpha for our investors. So yeah, mutual fund managers have done a good job.
Right, and the counter argument to that could be that mutual funds have done precisely because the markets have gone from 100 to 36,000. what if things were not so buoyant for the next
So,
few
again,
years?
we come back to this where we started
Yeah.
off, that ultimately markets will reflect the profitability of companies in the long run. The companies will reflect what happens to the economy in the long run. Indian economy has grown at a nominal rate of about 12 to 15% over the last 20 years. So, when I say nominal, it means real rate, which is our
That's
GDP at about
inflation.
6 to 7, and inflation of about 7 and 8. So, if you add the two together, about 15% has been the nominal growth of our economy for the last 30 years. So, mutual funds will reflect what's going on in the economy to a large extent. So, unless you buy funds which, let's say, diversify globally, and now you will then get the experience of those economies as you invest. So, fundamentally, markets are supposed to reflect what goes on in the real economy in the long run.
Right. So I'm going to talk about risk appetite in a bit. Before I do that, but let me ask you, since you've already wandered into that territory, let me ask you about the economy, because finally everything will depend on economy, how companies do, because however hard those CEOs work, if the economy in itself doesn't support their products or services, then we have a problem.
Well, I am very bullish on the Indian economy. I think everyone is, whoever is in this country today, I think is very bullish. And the reason you're bullish is, one, we have a large manpower, because fundamentally you need people. Second, you need people who are young, entrepreneurial, wanting to grow, ambitious. So with today's day and age, you meet any young individual, I see very high aspiration and ambitions, and that then translates to buying into the marketplace, and that buying then results into investment demand. So as a result, you will see that if all these factors are there, why shouldn't India do well? So I do believe that at any point in history, if you look back, probably we are in the best of times. As you go ahead, you can also leverage technology to make your growth more rapid. So I do believe that these are big opportunities, whichever sector you look at in the real terms for the economy.
Right. So, and let me quiz you on that a little more. But before that, if anyone has questions, feel free to send them or write them on the Facebook wall for UTI Swatantra, and my producer is going to give me the questions which I'm going to pose to Suraj. So, is the entire economy likely to grow? I know you said a lot of sectors are likely to grow, but some will and some won't, and there is a cyclical nature, or there is a larger cycle that is playing where some industries will die because of technological change and so on. Are we fundamentally ready to anticipate these kind of dramatic changes?
Well, let me put it differently. I think here we are trying to look at our economy from an investment perspective. So let's take an economy of the Middle East, which is dependent primarily on oil. So whatever happens to oil prices, that's what determines the growth of that economy. Similarly, if you look at Latin America, you will find a similar experience. But when you look at the Indian market, right? So if you look at the market capitalization today, almost 30-35% is financial services. So financial services is very part of our economy. And if we believe that the financialization of economy is a reality, people in future would want to save in financial instruments rather than physical instruments, I think the growth in that segment is really huge. So today when you look at lending companies, asset management companies, stock exchanges, you look at any segment, insurance companies which are listed in the market, banks which are listed, they are great opportunities to invest in. Similarly, healthcare in India, we have got a great manpower, we produce drugs, we export them. And so I do believe pharma is a great industry.
Right. So finance and
industry.
pharma are the two big ones.
IT would equally be large, because we have a very large workforce which is employed in that segment. So I would say that most of the sectors. So the point I'm trying to drive here is that unlike other markets, Indian economy is fairly diversified, and hence the stock market also represents that diversification to a large extent. And that I think is a much better situation to be in. But if you were an investor, let's say in the Middle East as an example, you'll be primarily driven by what happens to oil, and so you don't get too much of diversification.
Right.
You have to invest outside of the Middle East to generate. But luckily for Indians, we can just invest in our domestic companies here and we'll be better off.
Right. So, and if I were to ask you to look at what's happened in the last 20 years again, the performance of the economy versus performance of the market, has it been consistently moving? The reason I'm asking this is, suppose I'm an investor who's about to put his or her money into mutual funds.
That's right.
I'm looking for signals. So, what are the signals that I can see which you can relate to me from the past, that I can use as a simple investor and then say, okay, I can take confidence from the fact that this is what is growing, and therefore let me put my money into mutual funds, because that will in turn benefit that, reap the advantage of that growth.
Sure. No, so as I started off by saying that if you look at India's GDP growth, that's been roughly about 15% in nominal terms. Now, when you come to the stock markets as well, you will find that typically the earnings, the growth that you're seeing, and also, what the valuation you get on those earnings. So, yes, there are volatility from a year to year basis, but by and large, you will see that 15% number getting reflected in the stock markets as well. And the reason is that obviously we have a well diversified, market. As a result, we are able to capture the gains of the economy, pretty well compared to many other markets. So I do feel there's a very strong correlation in India on how the broader economy does and how your investments would do in that same environment.
Right. So a question on timing, right? So it's a perpetual question. I mean, we may have posed it 20 years ago. We will pose it now. The markets are at an all-time high. So should I be investing now? Should I be waiting for a little longer? And won't I be losing out if I invest today rather than wait for a little longer?
Well, I can give you one simple example and answer this. So 2008 and 9 we know was the global financial crisis. The markets had peaked at about 21,000. So let's assume there's an individual who started at 21,000. And here I'm taking an SIP investment, which means you saved every month into the market from that date onwards. After a year, the market had dropped down to closer to about 9,000 levels. So anybody who came at 21 is sitting on more than a 50% loss in 1 year's time. Very disappointed. Now this person who came at the bottom of the market, very lucky, you invested at 9,000. Within a year, the market went up about 50-60%. So they were really sitting on a very handsome gain, at the end of second year. But just if you were investing every single month a fixed amount from the peak of the market or the bottom of the market, and you stayed invested for the next 9-10 years, you'll be surprised that both the investors made almost identical returns. And the reason was that somebody who started at the peak kept on buying all the way down. So it captured the entire leg on the downside. But here, this person captured only one side, which is the upside while investing. So as a result, if you do a 10-year period, because market eventually currently is at 35,000, right? So all the investments have done well. And so that's the reason I believe that timing is actually irrelevant. What is important is how long can you stay invested in the market. And as I started off by saying that a 20-year period can help you really translate your savings into wealth. And I think that's why you should be in the markets, not because of just doubling your money over the next 5 years.
Right. So Suraj, questions coming in.
Sure.
Can we, Madhusudan Jaina asks on Facebook, can we rely on past performance while choosing a mutual fund?
Well, it's like if you're interviewing a candidate and what do you start with? You start with past performance. Unfortunately, there's no other measure, right? But yeah, what you can do is that you can also do some forward-looking research. There are research agencies who independently do that, give a rating independently on where the future will sustain. But I do believe that unfortunately there's no other tool but relying on past performance. And if more than the past performance, what's important is the core strategy the fund adopts. So in an index, you're just replicating, so you don't have to break your head. So you don't have to worry about what the fund manager is doing. But if you are investing in an active fund, I think it's a good idea to understand what is the primary source of gains which the fund manager does. And in our business, we translate that into growth or value. So typically, if you're a growth investor, then you are really buying into companies which you believe will have secular growth, and you do not give too much weightage to valuations at given point in time, because you believe the companies will grow much faster. And the other set of companies is where you're seeing an improvement in corporate performance. So we call them value. So today the companies are not doing well, but you expect that these companies will turn around, and hence you want to invest in them. So in the former category today could be companies in the consumer sector, and you can find companies in, let's say, pharma today, where the pharma sector is beaten down, and you'll get good companies there, and both make money in the eventual space. So what is important is if you're consistent with your approach, chances are you'll do better, rather than swinging from growth to value.
Right. And equity it is. The question that you're seeing at the bottom of the screen, equity, gold or real estate, I think we've concluded, at least for now, that equity is really the best bet. So it's not to say that you should not invest in gold or real estate. So the next question that's coming to you, Suraj, is one of the big advantages of mutual funds is that it has an inherent, or it offers inherent diversification. How is that? Satyan Kumar has posed this question.
Well, the reason it happens is one, basically from a SEBI standpoint, you cannot invest in any company more than 10%. Most of the fund houses will have internal benchmarks, so they will have sectoral caps, anywhere between 30 to 40%. So as a result, there are so many risk measures which are built in, that you will typically have in any portfolio 30 to 50 companies, and sometimes even higher. And that's why you inherently achieve diversification when you come to a fund. And that's why they are much safer, in relatively speaking, because you are spreading your money across many businesses rather than just buying one and taking the risk of it.
But in your own experience, have you ever been caught by surprise?
Well, markets are always full of surprise. I don't think so. There's a period when you're not surprised.
So one is the 2008 kind of surprise. You have a financial meltdown, the whole world goes for a 6.
Yes.
But when companies have suddenly surprised, the black swan events. Have you ever faced
so
them?
many of them actually? So that is a normal thing. So you may find a company X like
or an industry for that matter.
Yeah. So I think there are many such examples. So without naming, I think in the IT sector we had one of the larger companies which went down under surprisingly overnight. So those events are quite common, but most of the fund houses, as I mentioned, would have a prudential number of investing in those kind of companies, and as a result they are able to absorb that loss should something go wrong. So it is not that companies will fail, some of them will fail, but overall they are still able to do much better and capture the gains.
So that was my question, because when you have a diversified approach, your diversity will also account for the risk of something going under.
Absolutely,
in the
without
worst
doubt.
case.
Yes.
In the worst case.
Yeah, so
but and the ones who are not going under will make up for the performance of that.
Generally they make up. Yeah, that's what has generally happened. So that's what is expected. So unless you bought a sector fund, so then you can have one company which is very large. So if you're buying diversified funds primarily, I don't think so you will have a problem as far as diversification is concerned.
Right. And sectors themselves, because for instance you mentioned IT, you mentioned pharmaceuticals, you feel that these are fairly not recession proof but at least shock proof?
Well, I don't think so you should think on those lines, because any sector which may appear today recession proof but may not be into the future, we don't know what future holds in us. So typically the saying here is that if you will only lose money if something is on a secular downtrend. So individual stocks can potentially be on secular downtrends, individual sectors can be on secular downtrends, but the broader market is very unlikely to be on a secular downtrend. So I think SIPs, for example, will not work if you are investing into something which can be on a secular downtrend. So a lot of people apply SIPs to direct equity, their favorite stocks, but that's not really averaging in my view, because you're taking a risk on one particular company and you're taking a very huge bet by not diversifying away from that company. So I generally don't recommend sectoral investing or thematic investing, or for that matter investing in stocks till you really become an expert. You should be with diversified funds till you really reach a stage where you believe that you can participate in such investments.
So another question from Sujoy Ghosh, with SEBI recategorizing mutual funds, will fund managers find it difficult to generate healthy returns on investments?
Well, it's not an easy question to answer because it's just happened. Our belief is chances are the fund managers still have enough elbow room. May not be in all the categories. So for example, in the multi-cap category, in the value category, there's enough elbow room available with the fund managers. In large cap, relatively the elbow room is less because you have to invest in companies 1 to 100, as per market capitalization. But our view is that typically, good fund managers will find a way out and still outperform. So it is not necessary, that this is a restriction, because fundamentally what outperforms the market is good quality companies. Until you believe that you can spot them and be invested in them. So even if you're large cap can become very large, giant, mega cap, as we say. So I think opportunities are there across all these segments at this point in time. It's a little untested, so I don't want to really jump the gun here, but I would say that multi-cap and typically if I look at value should not be an issue. And also one of the categories where many retail investors participate, ELSS, right? That doesn't have any such restrictions, equity linked savings schemes. So I think there are enough segments and products available to beat the markets.
Right. If I were to ask you now for a horizon for the next year or so, right? We've got a lot of either uncertainty or events happening in the next few months and going up to a year with the parliamentary elections in 2019. And if I am going to be investing, should I be thinking of that or not thinking of that?
Well, I don't think so you should be thinking, because every time there were events, and which worried us all the time. The best example was, let's say last year, we were worried about Brexit, it's come and gone. We were worried about Trump, he's around, so it's not that.
And the markets are up.
And markets are actually up despite, all the negative hype that was created around it. We have geopolitical tensions in Korea, but still markets continue to rally all the time. So I don't think so one should really worry about these events. What you should worry about is your own future, that are you saving adequately? Are you going to retire wealthy? Do you have a plan for it? You're doing something about it. I think, are you on your way to your financial freedom where we started off? And those are more material and important questions rather than worrying about where is my next return going to come from. And I'll give you a very simple example, that if you're a very smart investor, let's say, but if you invest just, let's say, 10,000 rupees. Now, even if you double your money, 10,000 in a year, one time, let's say, I'm just giving an example, a trivial investment, and even if you double it in 3 years, all you have gained is 10,000. is that enough? The question is, how much is really money that is invested, you're saving? What is your plan for it? Are you really prepared for your children's future, their education? I must say that, the education costs are going up tremendously, because many Indians, want to send their children abroad, and those expenses are very, very large. In fact, I have been found flat-footed myself, because I thought I had done a great plan for my daughter. But reality is the actual expenses are very different from what I could envisage, 15 years back.
Yeah, and the rupee has obviously not
and rupee has, of course, absolutely. So I think one should be more worried about their own goals rather than really worry too much about markets.
Right. So on that question, you used the figure. You said 10,000 rupees, and then you also talked about how, sort of focusing on yourself rather than what's happening in the rest of the world. So if I had that 10,000 rupees, who do I go to? How do I really start the process, and what's my next step, so to speak?
Well, I think there are primarily, if you are starting off, I would certainly recommend that you try to locate a mutual fund distributor or what we call a registered investment advisor. There are two formats which are available to choose from. My sense is an RIA may not be interested with a very small amount, though some of them genuinely might be interested, but a mutual fund distributor, which could be independent, in nature. These are individuals who really practice this and, guide people on their investments. You have banks which do that, so you can walk into your bank and do that, or even you can call a MF house and discuss with them, then on, how they can go about investing. So, but ideal route is to locate a good distributor and be with them, because that's the best source of advice that they can get.
Right. So we've got a few more specific questions, and let's run through them quickly.
Sure.
What tax benefits do equity mutual fund offer, asks Balakrishna.
Well, I think two kinds of benefits. So if you're buying an ELSS product, that is eligible for any investment in that can be captured under section 80C. So whatever you save, you can, depending on which tax slab you are, you'll get certain advantages with that. Secondly, if you hold this investment for more than a year, there's a concessional tax rate of 10%. So that's a second big benefit you get. Third and most important, the mutual fund per se is tax free so when they churn their portfolio, they don't pay any taxes. So if you manage it on your own, every time you churn, you'll be paying a tax. But a mutual fund manager can do that without any cost to you or anyone, because under section 10, mutual fund per se is tax exempt.
But I will pay capital gains when I...
Capital gains, yes, but the reality is you have to keep readjusting your portfolio. So those costs you will not incur. A mutual fund does not incur that cost.
Right. Okay, the next question, since we are going a little fast, for a one-time investment, what scheme is perfect for an investor, asks Achinta Nath.
Well, I think that's not a great question, because one-time investment for how long, that's a fundamental question. So if this money is genuinely long-term, I think you can buy any equity fund, you will be fine. But if your money is just
no,
for
it may happen that I had some money and I don't have it today. So I'm not saying that this is the way I plan it, but it may have well happened like that.
No, if that is the case, then you can just save in a liquid fund and don't try to invest it till you figure out. A time horizon is very important in the marketplace. Even if you're buying debt funds, markets, interest rate movements will lead to valuation changes for debt funds. So you need at least about a 2-3 year horizon, even if you're doing fixed income investing. So I would say, if you don't have a time frame, then be in liquid and keep your money safe.
Okay. Next question from Nand Kishore. He asked, is a mutual fund with low NAV better? Low net asset value is that
Well,
better?
it doesn't really matter, because NAV is just capturing the current market price, so I don't think so. NAVs are really a linkage. A low NAV has no correlation in terms of whether the fund is cheap or not. It may depend on how long the fund has really lasted, because it is reflecting the current market value. So it has no relevance.
Okay. Last question is from Kalyan Krishnamurthy. He asks, can a single investment be suitable for all investors?
Well, can a single size shirt fit all investors or all individuals? The answer is no. No, there's nothing called as a single investment that's suitable for all. I would say that depending on your own horizon, your own goal in life, you have to make a choice of an appropriate investment.
And set a time frame, right?
And set a time frame, yes, right. Absolutely.
Okay. And for all of this, you're also suggesting that go and sit with someone who can work with you on this and start allocate a little more scientifically than...
So I would say the fundamental road to financial freedom is start thinking about it yourself and give some time to it. That what do I really need? And then I think you'll get enough help, once you start seeking for it. But if you don't spend time thinking about it, this is never going to happen.
Right. So Suraj, last question. When did you start thinking about financial freedom?
Well, I think, none of us are any different.
So if you don't want to reveal numbers, you can say when I was very young, when I was young.
No. So I can tell you very specifically. I think when I became a father, that's the time I became very serious about investments. I feel that that's a point where you start thinking that, you got some responsibilities and you want to really take care of it. When I was single, like, you know, the whole thought process was where I can spend money, how I can enjoy. There was no question of saving in my head. So you're trying to buy the best watch, the best shoes, you know, that's how life was. But suddenly when you have children, I think you start becoming a little bit more conscious. But I would still advise, if you can be a little conscious earlier, it's much better. But in my case, it happened, you know.
So you're saying that you have experience to share on investing or starting to invest much earlier than many people do.
Absolutely.
Right. Suraj, that's very insightful. Thank you for sharing your experience, and thank you for joining us today.
My pleasure, and I wish all the people on the show, you know, the best
happy
of financial
investing.
freedom and happy investing.
And financial freedom as well,
Yes.
in ahead of Independence Day, August 15th, 2018. Thank you very much for joining us today. Thank you.
Thanks, Govindraj.